Hi, this is Stock Investor Davis. Let's take a look at MRK reviewing its 2023 quarter 2, looking ahead to its full year projections, and closing with a technical analysis of the current stock price. Please like and subscribe. Starting with the second quarter 2023 income statement, first thing I see is its net income, second highlight from the bottom, going from nearly $4 billion down to a loss of nearly $6 billion in this quarter compared to last year's quarter. We see that this is stemming from a large increase in research and development, going from less than $3 billion to over $13 billion in the quarter, and $17.5 billion for the first 6 months. Looking into this fluctuation, here we see the company recently purchased 2 new companies, Prometheus Biosciences in June 2023, allocating $10.2 billion to research and development, and Imago Biosciences on January 2023, allocating an additional $1.2 billion to research and development. We'll look at this again later when reviewing its cash flow statement. Coming back to the income statement and its fluctuations in its cost of sales in the first half of 2023, decreasing below $8 billion compared to prior year at nearly $9.5 billion. That's a 16% decrease in cost of sales, while the sales were flat. Selling, general, and administrative costs went up about $300 million. The other expenses declined from $1.1 billion to $250 million. Again, research and development being the big jump in costs, leading to a loss in income for the quarter and year so far. Sticking with revenue, which is relatively flat for the year-over-year thus far, but investigating its geography, we see multiple fluctuations in each region. The largest region, the US, saw a slight increase, which is good considering it makes up 46% of total sales. Other noticeable changes include Europe, Middle East, and Africa sales declining $1.3 billion, and China sales increasing $1.1 billion, essentially canceling each other out. These two regions combined make up a separate 35% of total sales. An additional revenue breakdown uses its products. I've highlighted a handful of products worth noting, such as Keytruda, due to its currently making nearly 41% of total revenue, which also grew 20% year over year. Other significant products include Gardasil, making nearly 15% of total revenue, also growing 41% year over year, and Lagevrio declining from $4.4 billion to less than $600 million year over year. That's a revenue allocation drop from more than 14% total revenue to 2% revenue. Then there are some small line items that we can continue to monitor, such as Vaxneuvance going from 16 million up to 274 million, which is a 17 times growth in a year, or Januvia going from $1.5 billion to $1 billion in total sales, a 33% decline. Transitioning to its balance sheet and beginning with its current ratio, we see its current assets are greater than its current liabilities, which is positive. When within current assets, we see its cash going from more than $12 billion to less than $6 billion, which we can attribute to the acquisitions we discussed earlier, and its accounts receivable going up more than $1.5 billion. On the other side, within the current liabilities, we see its loans payable current portion increasing by nearly $1 billion to $2.8 billion. This line item, in combination with its long-term debt increasing to $34 billion from $28.7 billion, can be linked to its acquisitions as well. Also see its accounts payable balance declining to $3.4 billion from $4.2 billion, and its other liabilities declining to $7.2 billion from $8.3 billion, likely driving its cash balance down to a lesser extent than its recent acquisitions. Finally, noticing its retained earnings dropping to $54 billion from $61 billion, again assumed to be relating to the recent acquisitions. Next, its cash flow statement. We have the more notable changes highlighted, beginning with its starting point, net income, which is a much lower starting point, going from more than $8 billion to a negative $3 billion. Then within its three functions, the operating, investing, and financing activities, we see the biggest changes being driven by the recent purchases of Prometheus Biosciences and Imago Biosciences. Specifically, the large increases in operating activities driven by the added assets, the big drops in investing activities as the company spent money to acquire these assets, and the large increases in financing activities as the company borrowed money to fund the purchases in combination with its own money. Let's take a look at these acquisitions further. We actually have three noteworthy acquisitions to review, with the first and third being current, and the second being more forward-looking and contingent upon performance. Starting from the most recent acquisition at the top, we see Merck purchased Prometheus in June 2023 for $11 billion. It appears the driving force behind this decision is MK7240 as a treatment of immune-mediated diseases, including ulcerative colitis, Crohn's disease, and other conditions. Prior to that, in February 2023, Merck agreed to terms with Kulin Biotech for multiple preclinical drug treatments of cancer. If performed to its full potential, can lead to payments from Merck of more than $9 billion over time, based on development, regulatory milestones, and sales milestones. It's safe to assume that if Merck ends up making the full $9 billion payment, it will have made multiples of that figure, which is not disclosed. Finally, in January 2023, we see the purchase of Imago for $1.3 billion. It appears that the driving force behind this purchase is MK3543, an investigational inhibitor evaluated in multiple phase 2 trials for treatment of thrombocythemia, myelofibrosis, and polycythemia vera. We'll continue to follow these and its impact over time. Moving to its 2023 full year guidance, we see management forecasting a relatively flat year in terms of revenue at roughly $59 billion, and earnings per share being cut to less than half, from $7.48 per share last year to an estimated $3 per share this year. A slightly more detailed guidance for 2023 shows revenue actually has been guided up from prior quarter by about $1 billion, and is assuming that the company will reach $1 billion in sales of Lagevrio. This is the product we touched on earlier with the big drop in sales, noting the gross margin staying consistent at a respectable 77%, also citing a big increase in its tax rate to over 30% from around 17%. This is due to the acquisitions and a big reason for the decline in earnings per share this year. A bright spot for this stock is that it continues to prioritize its dividend in the bottom right. It has consistently increased its dividend each year and is projected to be just below $3 per share. Transitioning to what the analysts are showing as of 10/15, we see the full year earnings per share is $3.04, which is in line with guidance, and its revenue at $59.35 billion, which is in line with guidance. both being on the high side of each guidance range provided. Jumping forward to today, the analysts have made some big changes toward the downside as of 10/25 in all earnings per share and revenue projections through year-end 2024. Focusing on this year, 2023, we see the analysts are now projecting MRK to miss on its full year guidance, projecting earnings per share at $2.86, which is less than the bottom of the range at $2.95, and revenue at $55.98 billion, which is also less than what management guided at $58.6 billion. Wrapping up with our technical analysis, MRK trading at $103. It appears to be trading sideways between 101 and 115 since November 2022. Support being at 101 and slight resistance at 108. I like the price. Thank you for watching. Please like and subscribe.